Now, working capital management, okay, we discussed is that the management of the components, of the constraints, okay, what makes up the current assets, what makes up the current liabilities is what referred to as working capital. So the management of those components, the current assets, okay, that is inventory, cash, okay, receivables, okay, money market instruments, okay, the management of current liability components, okay, the trade payables, the short-term loans, okay, the overdraft, okay, with a key objective, okay, with two key objectives, okay, of ensuring that a company you do remain liquid, okay, that is, you can be able to pay for your obligations as and when they fall due. At the same time, that you can be able to make profit from the investment that you have made, okay. So you want to make positive returns, okay, from the working capital investment that you have made towards the current assets, okay. So you also want to ensure that as a company, you do not have, for example, excessive investment. So you want to take a balance between these two objectives, okay. So I think that's what we should pick up, okay. Working capital management objective, okay. So the two main objectives, okay, that you want to achieve at a working capital or when you're managing your working capital components, okay. One of them is to make profit, okay. Don't forget, as we mentioned, the key context we want to take is is when it comes to working capital, okay, you want to ensure that as a business, you will be able to make profit. You are a PLC, okay? You are a public listed company, okay? You're not an NGO generally, okay? So when you mean by a firm, we want to mean that the firm you're dealing with is company oriented, okay? Towards maximizing the wealth of the investors, their shareholders, okay? Therefore, of course, their profit objective will have to be on top there, okay? So at the point when it comes to profitability objective, what you want to ensure as a business is that the investment you have made towards the inventory, the investment you have made towards receivable, the investment you made towards cash, okay, they do contribute towards the firm making profit. They do contribute towards one of the key major financial objectives of the firm, profit making, okay. What you have to be careful when it comes to the profitability is that even though definitely you do want to ensure that you can make profit from, for example, the sales from the inventory you have, okay, you have to be careful that in case you have an excessive investment towards the inventory, towards cash, okay, towards the receivable, you do make very minimal returns from them, okay. The investment you have made towards cash, the raw material, the work in progress, the finished goods, before you can convert them into an actual sale. Do not forget that you are making it's an investment. It's money that you put down on that particular account. Okay, and the return you make, okay, the return you make is very minimal until you're able to convert them into an actual sale and the cash is received. Before that, it's just an investment that is tied down. Okay, so therefore you want to ensure you don't have an excessive investment towards your working capital. Okay. The other objective is on liquidity, okay, as mentioned, you want to ensure that as a company, you can be able, okay, you can be able. You want to ensure the company, therefore, you can be able to have or to be able to have the obligations, okay, when it comes to, what's happening? Can you see my screen?
Yes.
Yes, okay. It is visible.
Okay, okay. Well, where did it go? Well, just give me a minute. Not sure how it went all the way. Well, what happened? Okay, no, I went to another screen together. Okay, thank you. That you want to be able, when it comes to, I'm not sure my screen is misbehaving, but okay, let's have it stopped. Okay, so when it comes to working capital, you want to ensure that as a company, you can also be able to pay for the obligations as and when they fall due. Okay, that you can build pay for. When it being that when we say that a company is deemed to be liquid, what does it imply? It implies, therefore, that in case it's an obligation, if for example the pay of the employee is going to be due this week, okay, can you be able to pay those employees? Okay, if you have an invoice from a supplier due this week, can you be able to pay for that particular supplier the amount you owe them? If the bills are, let's say water, utilities, okay, water, electricity, okay, the bills are due this week, okay, or today, or tomorrow, can you as a company be able to pay for those obligations as and when they fall due? If you can, then it can deem you that you are a liquid company, that you are a solvent company. If you can't be able to pay for those obligations, then you are illiquid, okay? And of course, definitely, generally you have to be very careful, okay? Especially when it comes to an SME, okay? When it comes to a small business, okay? You have to be careful when it comes to the management of your working capital, okay? Because you may be pursuing, you want to make profit, that was for sure, okay? Every business wants to make profit, okay? However, be careful. Also consider the liquidity impact it has as you chase the profits, okay? Because in case you have excessive, in case you do make high sales volumes to your customers on credit, something good for business, but be careful. Can you be able, before those customers pay, if you do sell on credit and the amount is going to be due at the end of the month or 2 months from now, between now and then, before you get the money from the customer, do you have cash? Do you have liquid assets that you can able to sustain your operations? Okay. So as you do try to attempt to chase on profit, you have to be careful. What is going to be the impact of you trying to chase this particular objective on the other objective? Okay. Because in most cases, those two objectives will be in conflict. Okay, so you want to ensure that you do strike a balance between these two objectives. Okay, at the same time, you don't want to have excessive liquidity. Okay, you don't want to have excess cash than what you need. Why? Because in case you're going to have cash, you're going to have cash in a current account of the bank. Okay, how much interest is it going to earn for you? Nothing. Okay, there's no any profit in quote it is going to make for you. There's no any interest the current account is going to make for you. There's no interest you're going to earn for having cash in your cash book or in your how do you say in your interest system. There's no any return you're going to make. In case you're going to be investing in the short-term money market instrument, like T-bills, commercial papers, investing in the bank in CDs, certificate of deposit, yes, you can make return. But how much down is the bank going to give you in the case of certificate of deposit? How much return is the government going to give you if you have to invest in T-bills? Very low returns. Okay, so yes, you're going to be liquid. Okay, because you have you are investing in liquid assets. However, what impact is it going to have on your profit? Okay, it is in case you have excessive liquidity, it implies therefore you're losing money. You're not making profit, whereas you're making profit by you trying to invest elsewhere the excess cash that you don't need. Okay, so therefore, when it comes to these two objectives, it's simply about trying to ensure that you can strike a balance between the two objectives. Do not pursue one objective exclusively, in short. Okay, try to ensure, in case you want to pursue profit, ensure you also make analysis, the impact of your action, the impact of your profit chasing actions on the liquidity. Okay, strike a balance between these two objectives. Okay, I think you've seen firms that generally do struggle to pay their input, to pay their suppliers. Okay, I think you've seen the case of NACMAT. Okay, all these the case of retailers. Okay, there are so many things that will have to come in play. Okay, but of course, as a business, especially in the case of a startup company, be very careful when it comes to the management of the company working capital. Okay. Okay, we shall do this later. Now, as the one in charge of management working capital, there are a number of things that you have to check to assess the extent to which the company is able to manage its working capital. Okay, to what extent are you able to manage your working capital as a business? Okay, so one of the method you can use when it comes to assessment of the company efficiency in managing working capital is called the cash operating cycle. Called the cash operating cycle. Okay, and by conversion, the operating cycle, which I think I'll mention later on. But generally, the cash operating cycle, okay, is used to make an assessment. Okay, how long do you take as a company? Okay, from the time that you invest, from the time that you do pay your supplier, okay, to the time you're going to get money from a customer. What is that time? What is the time that elapses between the time you paid your suppliers to the time that you got money from your customer upon making a sale? Okay, what that time difference? What the time that elapses between those 2 points? Okay, I'll call the cash conversion cycle or the working capital cycle. Okay, now in case example, okay, maybe just to go back and think about that definition. Okay, that the cash conversion cycle, also referred to as the cash operating cycle, also referred to as the working capital cycle. Okay, So you're saying that it is a time difference, the time that you pay your suppliers, the time that you get money from your customer. Okay, that time difference is what that was the cash conversion cycle. Which implies therefore, since you have paid the money to your supplier, it means in quotes you are out of cash. Okay, because you have paid your suppliers. Okay, but you have to get the money from the customer. So in short, what the time difference when you don't have the money in short? Because we are saying that it is time difference in the time you pay your suppliers, the time that you get money from the customer. So at the point when you pay your suppliers, it means your cash has this cash outflow. There's money out of the business. Okay. So what is time difference? The time that you pay your supplier, the time you get money. This is time when you are out of cash. Okay, is in quotes the period where the company is tired of cash. Okay, so in case this cycle is increasing, in case it was 10 days last year, this year it's 30 days. So the cycle is increasing. It was 10, this year is 30. Now, what does it indicate regarding the company working capital management efficiency? Is a firm becoming more efficient or becoming inefficient? Okay, just one other question. If the cycle or if this cycle was 10 days, okay, last year, okay, this year it is 30 days, so it has increased. So can you reprimand the management or can you give them bonuses? Joseph.
I think in that scenario, the CAM is becoming inefficient.
Yes, the company is becoming inefficient. Okay, don't forget you said that the cash conversion cycle is a time when you are out of money. Input. Okay, which implies therefore if you're out of money and now the days are increasing, it means if we have more days when you don't have money. Is it good for the business? No, it's something bad for the business. So in case the cash operating cycle is increasing, then it is an indicator that it may be an indicator of company becoming inefficient in managing its working capital. Okay, the company may be becoming efficient in managing its working capital. If the cycle is decreasing, in quote, the company is able to push the items around in order to reduce the cycle. Yes, how it is. Okay, the company is able to push items around and lower its working capital, then that is a good indicator. Okay, if the cycle is decreasing, it was 50 last year, this year is 25, then that's a good indicator that you are able to get cash quickly. Okay, we are assuming all the factors remain constant. The profit you're making last year and this year the same. The only difference is that now you're able to get cash quickly, and of course that's something very good. Okay, so the cash conversion cycle, the cash operating cycle, okay, can be used as indicator of how efficient you are as a company in managing your working capital. So let me have my board here just to explain more on the cycle. You say that the cash flow cycle is the time difference for the time that you pay your suppliers, okay, the time that you do get money from the customer. Let's say the case of a company involved in manufacturing, okay. So in the zero, and see that here we are in the zero. Okay, so here in the zero, assume that we buy raw material, okay, so purchase of raw material. So you're taking the case of a company involved in manufacturing, okay? So a company involved in manufacturing, okay, not a service-oriented company, okay? They are converting raw material to a finished good. So in day zero, this company buys raw material, okay? Make assumption that this company, the conversion process doesn't begin immediately, okay? The conversion process does not begin immediately, okay? It is going to take some time before the conversion begins. Assuming that we purchase material in day zero, however, the process of conversion of the material to a good, to a finished good, there's a 10 days difference, okay? So here, I'm seeing that in day 10, that's when the production, okay, let me actually increase here, let's make it more good. So in day 10, this is, let's say, production start. This is when the production begins. Okay, so this is an assumption that you bought the goods last week on, let's say on Thursday, okay? And you're going to start conversion of those goods this week on Friday, the end of this week, okay? If that's the case, therefore, that's what I said, therefore, there's a 10-day difference from the time that you receive the material from the supplier to the time you start production of those goods, okay? Now, assume that the conversion doesn't, okay, well, there's a time, but the time that we start the production process, the time we get the goods, okay, from the time we start the production, we don't get the goods within an hour, for example, okay, we are going to take longer, okay, it's an assumption, okay, because of course there's some farms that you start production, within 10 minutes, you have the goods finished already, okay, the case of, let's say, the case of this confectionery businesses, okay, case of, I don't know, canned breast, okay, so those are definitely in case you start production, minute one, in the next 3 minutes you have the bread already. Okay, so that's a simple production process. Let's assume a case where a company there's a time difference. It takes time. Okay, from the time that they start production, the time they get the goods. Okay, and assume for this company, for this business, here they do take, let's say, 15 days. Okay, so here in day 25, that's when they have the finished good. Okay, so it takes 15 days to convert the material to finished good. Okay, then that's actually making. Okay, we start in day 10. However, we do get the goods in day 25. Okay, so there's a 15 days difference. Okay, now another assumption we can make. This company will have to deliver these goods from the factory to the suppliers, to the distributor. Okay, this company deals with the distributors. Okay, now from the time the company has the goods already finished, okay, the time that those goods will reach to the customer, will reach to the distributor. Okay, for example, okay, there's time difference. Okay, okay, so assume that in day 25 they do take, let's say, 5 days. So the goods do reach, rather the goods reach the distributor in day 30. Okay, so here it's when the company make a sale, okay, to those distributors. So the company sells to distributor, but between the 25 and the 30, the company is planning, the company is having logistical, is maybe transport the goods, okay, to the distributor. So there's 5 days difference. From the time that we have the finished good, the time that those goods reaches to our customer or reaches to our distributor is a 5 days difference. Okay, ensure that we make the sale in the 30. Assume that actually, okay, that we don't sell to them on cash. Okay, we sell to them on credit. Okay, since they are our customers, they are distributors, then of course you're on agreement. Okay, don't pay us today. Okay, pay us, let's say, 30 days later. Okay, so we make sale in the 30. However, we receive the cash in the 60. Okay, 30 days later. Okay, so this is cash receipt. Okay, from sales. Okay, this is cash receipt from sale. Okay. So that's a simple company that is involved in manufacturing. Okay, this is a company involved in manufacturing. Okay, now assume that we bought those goods. Okay, we just highlight we bought this raw material on credit. Okay, the supplier do deliver to us on credit. Okay, we have an agreement with the supplier that they're going to deliver the goods on credit. The agreement is that we pay them in day 15. Okay, assumption, not assumption. So here in day 15. We make payment to supplier. Okay, this is payment to supplier. Okay, payment. Let me just make it a bit better. So this payment. Payment suppliers. Okay, so in the 15, that's when we do pay our suppliers. Okay, because the agreement is that we buy raw material on credit, we pay 15 days later. Okay, we have said that the cash conversion cycle, okay, is the time difference between the time you pay your supplier, the time that you get money from your customer. That's called the cash conversion cycle. Time difference, the time you pay, just highlight, the time you pay your suppliers, the time you receive cash from your customer. That the time difference, the time that elapses between those 2 points is referred to as the cash conversion cycle, the working capital cycle, or the cash operating cycle. Okay. What implies therefore? The cash flow cycle, we can summarize, okay, is given us A, I call this from this point to this point. Let me just call this A. This 10 days here, I call A, okay, plus B from this point, for the time that we have production begins, the time we have, just a minute, this off. Okay, from this time to the time that we have the production beginning, okay, when the goods are finished, let me call this as B. For the time that you have the finished good, the time you make a sale. Okay, let me just extend downwards here. We call this C. Okay, that is from the time we have the finished good to the time that we make the sale. Okay, that is C. And from the time that we make the sale to the time we receive cash, we call this D. Okay, so you can see therefore these 60 days, okay, these 60 days in quote is made of A plus B plus C plus D. Okay, what is A? A is what referred to as from the time that you bought the raw material to the time you start conversion, we refer to it as the raw material period or the raw material day. Okay, so A is equal to raw material days. Okay, so A is called the material days. From the time we receive the material from the supplier to the time we start conversion of those material to a finished good. Okay, that's referred to as the days for material. Okay, from the time we start production to the time we have the finished good, what do you call it? From the time we start conversion to the time we have the finished good, okay, between the 10 and the 25, what do you call it?
Production days.
It's called the production day. Thank you. Okay, so B is equal to production day. Production days, also referred to as the work in progress days. Work in progress days. Okay, so it is one the same thing. Work in progress days or the production days. Okay. Now C, in the time when we have the good. Okay, so C from the time that we have the finished goods. Okay, and the time that we make the sale. Okay, it's when in quote the goods are yet to be bought by customer, but they are already complete. They are in the store. They are in the where. They are in the with the distributor, more or less. Okay, if we do not make a sale, if we do sell. As a company, in case you do sell using factory shops, okay, quite clear, but that's not the case, okay. Then of course, C is going to be very minimal, okay, because it's simply at the time difference for time we have from the factory to the factory shop, okay. We have a company that have factory shop, okay. So in case you do sell through your factory shop, then it's from the days from the time you have the finished good to the day you have your sale you're making sale, okay. The time difference from the time you have the finished, you have completed the conversion process from the factory to the factory shop until the customer comes and buy that commodity. Okay, that time difference is what do you think is called, by the way? From the time that you have a finished good, okay, assume that you are Toyota Kenya. In case you are Toyota, okay, assume that you are case of Toyota, okay. From the time that you do receive, okay, those motor vehicles, the time you're going to sell that motor vehicle, the whole that time difference, that's what do we call it? You have received the goods, okay, in the case of Toyota Kenya, okay, you are not moving one manufacturing, okay, yours is to sell already complete units, okay, so we can see that C, okay, in this case the C here, okay, is simply when the time you receive those finished commodity, okay, from Toyota, from Japan, okay, to the time the customer is going to come and buy that particular unit. What do you call that time? What do you call it C, therefore? Based on what you have done, what is A, what is B, what is C, therefore? If A is days for material, B is days for work in progress, what about C?
Finished goods.
Finished goods days, thank you. The finished goods days. Okay, it's called the finished goods days. Okay, that's what we refer to as C, the finished good days. Okay, then you have D. Okay, D is the time you make a sale, okay, to your customer to the time that you receive money from your customer. What's the time difference? What do you call it? The time you make a sale to the customer on credit to the time that the customer is going to pay you money. What's the time difference? What do you call it?
Collection days.
Yeah, more or less. It's called the debt collection days. Okay, I agree. Thank you. It's called the debt collection day. Okay, more or less what we refer to as the debtor's day. Okay, debtor's days, or also called the days for receivable. receivables days, or simply would call the debt collection period. Okay. Now you see that the cash conversion cycle, okay, is equal to A plus B plus C plus D minus 15, okay, because don't forget we did subtract here, okay, minus 15. We check here, it was 60 minus 15, okay. This is when the cash count begins and ends here, okay. So it's equal to, therefore, 60 minus 15. Now what is 15? What is this 15 here? What do you call it? From the time that you buy the material on credit, the time you pay the supplier. What's the time difference? Let me call it E. What do you call it E?
Payable days.
It's called the payables days. Thank you. It's called the payables days, or simply the creditors period. Okay, payables days. Okay, therefore, this context, therefore, you can see therefore the cash conversion cycle is 60 minus 15 to give us what, 5. Okay, 60 minus 15 to give us what, 5. Okay, clear? Okay, and we can summarize. Okay, this graphic is just to help you understand what you mean by that. Okay, you don't need to do this in exam. Okay, so just to help you understand. Okay, now in case I was to summarize what we've just done in that graphic here, okay, we are saying that the cash conversion is given as A plus B plus C plus D minus E. Okay, plus E. Where A we are saying is the days for material. Okay, raw material days. So all these are days. So, okay, plus the days for work in progress, or the production days, work in progress days, plus C, where C was the finished good days, finished goods, okay, days, plus D, where D we are seeing was it is equal to the days for receivable, okay, debtors day. So actually, let me just go back to our graphic here. A plus B plus C plus D, that is from the time that you did invest, you did purchase the material, all the until you do receive cash, the 60 here, these 6 days you have here, okay, is what referred to as operating cycle. Okay, so this is what referred to as the operating cycle. So there's 15, let me just go back. A was 10, so 10, let me just have it here, okay, so 10, okay, so this is for our example, our graphic there, our example there. 10 plus, it was 10 plus, here 10 plus B was 15, so this is B here, it was 15, so plus 15, plus the finished good days, it was 5, that is from here to here, 5, plus the days for receivable, 30, to give us 60, this will refer to as the operating cycle, okay, this will actually, let me just use a different color, okay, this what was not the best color. This what was the operating cycle. This what referred to as the operating cycle. How long do you take as a company? From the time that you do invest towards your working capital to the time you get cash. So operating cycle is the time taken for the company from the time that they invest towards working capital to the time that they are able to receive money from their customer upon making the sales on credit. That time, the length of time, is referred to as the operating cycle. And back to our business, we are saying that we want to get a cash conversion cycle. Now minus E, so E was minus, okay? So let's E, where E was the days for payable. So payables days. In case there's payables days here, then we get the cash operating cycle. The cash operating cycle, working capital cycle, or the cash conversion cycle, okay? Just underline it, okay? That's where you get the operating cycle or the working capital cycle. Okay, so for example, for the example you've just done, minus 15 days, okay, to give us 45 days. And that's to get the cash operating cycle. Now, therefore, to make, don't forget, this is a measure you can use to assess how effective the managers were, okay? So we are still trying to compare what was the last year's cycle and what is this year's cycle. Has the cycle increased, okay? If last year it was, just for if last year the cycle was, let's say 30 days, okay, so it was 30 days here, okay, this is 2019, just for example, and this is 2020. So there is increase from 30 to 45, then you can be able to conclude and say for this company, it is taking longer to get cash this year compared to last year. So the company is out of money, in quote, longer period of time for this year compared to last year. So it is an indication there could be some element of inefficiency in managing the working capital. Of course, the same applies also, the same interpretation applies to also the operating cycle. If it is increasing, last year it was 70, it was maybe last year it was, actually this is a good example. If last year it was 70, and now this year it is 60, what does it indicate? If the operating cycle last year was 70, and this year is 60, what does it indicate?
It indicates that there's efficiency in the operations.
So it is an indication the company becoming more efficient in its operations.
Yeah.
Yes, I agree. Okay, but before you go, it's an indication that the company becomes efficient when it comes to its operation. But how comes the days here are increasing? The days here are increasing. They are increasing here, which is 45, but here they decrease. What was the main issue? Because here you say the company is more efficient. No, the company here is efficient, okay, compared to last year. But generally, this company is becoming more efficient for this year, 2020. Because last year it was 30, and this is 45. You can see here, you can see the contradiction there. Last year, the cycle was 30, this is 45. However, the operating cycle, here it was 70, it was 60. What will be the issue this year? Was first of all, the company is becoming efficient in terms of getting goods complete, okay, getting a sale and receive cash. For the time the company invests towards the material, the time that they are able to get cash from a customer, for the 2020, the company is better off. However, in totality, it becoming efficient. What will be the contributor?
They're taking longer to pay their payables.
They're taking longer or shorter? Think through.
Oh, that.
If you're taking longer to pay your suppliers, to pay your payables, what happens to this payables day? Do they increase or reduce?
They increase.
Increase. So in case the payables day increase, what happens in the cycle therefore? Does it increase or reduce?
It reduces. It reduces.
So, okay, it's going to be reducing, but this year it is increasing. So are you paying your supplier quickly or are you taking longer to pay them this year?
You're paying them quickly.
Yeah, that's the thing. It can mean therefore that this year, as a company, you're paying for your suppliers quite quickly. Maybe you have issues with them. Okay, maybe last year you were not too good with them. You never paid them on time. So this year you had a new contract with them. They tell you that way going forward, you're going to be reduced the number of days we give to you. Okay, that's why maybe the days are increasing. That's why maybe therefore you're not able to manage your suppliers well. Okay. Okay, that is one of the elements of working capital management. How do you manage your suppliers? Okay. Anyway, so that is for that. Okay. That's how therefore we get the cash conversion cycle as well as the operating cycle. Clear?
Clear.
Immaculate, you have a question?
Could you please explain again why the relationship between the operating cycle and the cash conversion cycle?
Okay. So let me just give this example that we have here. that here we have said, this writings here. Okay, that this year, okay, this was 2020, this was 2019, sorry, this is 2020, this account here, and these are figures for 2020. Now you see that the operating cycle here, okay, if you have to just assess purely from the operating cycle perspective, this year the company seems to be better off because the days are decreasing. Okay, the company, the days are decreasing. Last year there was 70, this year they are 60. What does it imply? I mean, the company took shorter. Okay, they took a short period of time from the time they did invest in working capital to the time they exit. Okay, exit the quote, the cycle. Okay, let me just go back to this particular graph we do here. Where there's a different ink I can use here. Let me just use this. So here, this is when the company did invest towards working capital. This is the time the company has exited, in quote, the working capital. That's referred to as the operating cycle. Okay, that's referred to as the operating cycle. So for last year, the 2019, this was 70. This is 60. Good for the business or bad? This is good for the business. It means you took a shorter period of time. However, if we go further and analyze on the effects on the cash operating cycle, okay, this is 45, last year it was 30. What does that mean? Okay, actually, what figure is going to give us 30? Here is, let's say, 40, isn't it? So this is a minus. 20 minus 70 minus 40 to give us 30. Okay, what it means, therefore, last year the suppliers were willing to give you more days. They gave you 40 days. This year they're only giving you 15 days. Is it an indicator of good suppliers management or an indicator of poor suppliers management? It's an indicator of poor suppliers management. Because in case you have good relations, in case you do have good terms with them, they're going to give you goods on credit for a longer period of time. But in case it's decreasing from 40 to 15, then it might be an indication that you're not managing your suppliers well. That's why they're giving you lesser days this year compared to last year. And then because therefore the impact has on the company operating cycle, or the company cash conversion cycle. Clear?
Well, I'm still wondering. So if you take longer
to pay your
pay
supplier.
the supplier, you have a better conversion cycle.
Let me just say, okay. Now,
That's where I'm confused.
Okay, assume that maybe a retailer, okay, you are a shopkeeper owner, okay. Now, in case you have customer who buy from you and they don't pay to you on time, do you sell to them on credit or on cash?
On cash?
On cash, definitely, isn't it?
Yeah.
Yeah, to me, therefore, on their side, their payables days is very low, okay, or even zero, because you don't sell to them on credit, okay. However, in case you have good terms, you know that this person is going to pay me. So, as a retailer, would you be shying away from giving them goods on credit? If they're good people, that they do pay you on time, okay. So, would you want to give them more days or less a number of days?
More days.
You give them more days, isn't it? You give them more days, okay.
Yeah.
And that's what you're trying to say, that last year the supplier gave 40 days. This year they give 15 days. Why is that the case? I mean that there's some issue you had with the suppliers. Suppliers, maybe they don't trust you anymore, okay? That's to say that this could be an indication of that you don't have good management of your suppliers. If they're giving you less days, then that's what it could be indicating, okay?
Oh, okay. All right. I understand. Thank you. Yeah.
So that's on the cash conversion cycle, okay? And of course, what it means, okay? What does the cash conversion cycle imply, and what does the operating cycle itself imply, okay? So we can do an example. Okay, so let's do an example here. Okay, yeah, can do this example. Now, actually here, I may want to assume that we are getting the recycle N. Let me just add the cash conversion cycle. So let us get the both of them, not just one, but both of them. Okay, so give me the answer once you're finished. Yes, Akuta.
Operating cycle, I'm getting 119.
119 days.
Yes.
Okay,
Cash
so
operating cycle, 91.
okay, operating cycle 119 days.
Yes.
And the cash conversion cycle
91.
1 days. Okay, fair enough. We can look at it together. Well, simply don't forget the operating cycle is made of yes.
I'm getting a different answer.
Okay, fair enough. Okay, what do you get?
Operating cycle, I'm getting 161 days.
161 days. Cash conversion cycle
119 days.
119 days. Okay, there's a 10. Let's do it together. Okay, let's confirm. Now, first of all, don't forget we say that the operating cycle from the time that we buy a raw material to the time we get money from a customer, okay, or the time difference, okay. Now here we have the days for raw material is 21, okay. You can see my screen.
No.
No.
I'm trying to wonder what's happening with my. I don't know. No, it's okay.
Yes.
Yes.
Okay, thank you. Okay, so the cash operating cycle, the operating cycle first is to get what we call the total inventory days. Okay, the total inventory days is made of raw material, work in progress, and the finished good. So the three combined give us what we call the inventory days, which is equal to raw material plus work in progress days plus the finished good days. So the three combined give us the inventory days. So 21 plus 14 plus 28. Okay, so the three combined give us what we call the total inventory days. Okay, so 21 plus 14 plus 28 to give us how much? 21 plus 14 plus 28. So three combined give us what was the inventory days. To give us
63.
63.
63.
Thank you. To give us 3 days. So the days for inventory. So let me just have my work in here on top. So inventory days, the combined give us 63. Okay. Plus the days for receivable, which will be equal to, is given here, 56. So 63 plus 56.
190.
119.
Give us 119. So again, therefore, the cash on to give us operating cycle, therefore, be 119 days. Give us 119 days. The day for inventory plus the day for receivable to give us 119 days. Okay. If you less payable, okay, this is operating cycle. If we less the payable days, which in this case the payable suppliers payment period is here, is 42. If we less 42, then less 42, we get therefore the cash conversion cycle, which is how much?
77.
77 days, give us 77 days. Okay, to be the cash conversion cycle. Okay. Clear? Oh, how do you get to
Yes.
Excuse me, sir.
Yes.
I thought the cash conversion cycle is the total operating cycle minus the payable days.
Yes, it is.
Yes.
It's minus, not plus. I think you did add. Did you?
Yeah.
Yeah, you're
True.
meant to have
Yes.
you're meant to have subtracted. I think you added.
Yeah.
Yeah, you're meant to have subtracted. Okay. There.
Mm.
And that's how you get therefore the operating cycle and the cash conversion cycle. For this example, don't forget you can't be able to tell whether the company is doing well or the company is doing poorly. Why? Because you don't have the data to compare. Okay, to compare last year, compare with other firms, you can't make a mention regarding how efficient or how inefficient this company is. Why? We don't have the data for last year. Okay, or for a point of comparison in short. Okay, you can't make a comment. Okay. Now now generally, let me just go back to my board. Okay, so generally, in a main exam, of course, it's quite unlikely that you're going to be given these days 10, 15, 5, 30. It's you to do the calculation. Okay, you're meant to get the days for raw material, get the day for work in progress. You're not meant to do the calculation. Okay, so the next bit maybe is to calculate now the days. Okay, to get the days now. Okay, so let's get the days. What's happening to my board here? Okay. Not acting very well. Okay, give me a minute. This board of mine seems to have issue. Give me a minute. Okay, get another board here. The other one had an issue. Okay, let me hope this is going to be better. Okay, so generally, when it comes to even your main exam, okay, so the exam is not going to give you such a simple example. Joseph, you have a question, Joseph?
Sorry, it was raised by mistake. Sorry.
Okay. Okay, so when it comes to even the main exam, as I was mentioning, it's upon you to give the days, okay, upon doing calculations. So the examiner is not going to give those days. So it's upon you to do the calculation and get the cash conversion cycle. So let's begin the first one. We get the days for material, okay? So we just have a different pen. Okay, so material days. Okay, raw material days is given us the number of days you have per year. There is 60, there is 5. You can follow what the examiner gives you. Okay, or in case you're not given, so use whatever days you prefer. There is 60 or there is 5. Okay, we multiply by the amount the company invests towards the raw material. Okay, so generally at any point in time, how much does the company have in stock? How much material does the company have in stock? Okay, raw material. We divide by within that year, what was the total raw material that company purchased? Okay, raw material purchases. Okay, that's how you get the raw material days. Okay, there is 5. We multiply by raw material. In short, here the raw material is on average basis. Okay, how much can we find? How much of raw material? What's the value of the raw material we can find in the company store? Okay, in case we have to do what we call a stock take. Okay, how much raw material can we find? On average, how much raw material does a company have in store? Okay, we divide by the total purchases the company has made of raw material during the year. Okay, that's raw material days. Then you have next is the production days or the work in progress days. So work in progress days. Okay, given us that is 5. We multiply by the investment cost the company has towards work in progress. In short, the goods the company is having that are yet to be complete. Okay, they are not raw material, they are not finished goods. Okay, so what's the total amount the company have of work in progress at any point in time? Okay, we divide by the cost of producing those material, the cost of production. We divide by the cost of production. Okay. Next, we have the finished goods. Finished goods rate. 365. We multiply. What do you think is formula here, by the way? I think from the two formulas above there, you can go to deduce. How do you get the finished goods rate?
It is 365 days times finished goods
Times finished goods.
over cost of sales.
Thank you. We divide by cost of sales. Thank you. We divide by cost of sales. Okay. Just the normal way you prepare your P&L. Okay. Raw material, cost of production, cost of sale. Okay. We have raw material. We have work in progress, finished good. So the same way. Okay. So once you do a few examples. Okay. These formulas will stick. Okay. So don't cram them, by the way. Okay. The height is the formulas. Anyway, that's what we get. Therefore, the 3 give us the total inventory days. Now, if a company does not manufacture, like for example, the case of supermarkets, okay, and the retailers, they don't manufacture, so they sell an already complete unit, okay. In that context, therefore, if they do sell already complete units, and therefore they don't have raw material, they don't have work in progress, they only have the finished good. So you don't need to get these days. You don't need to get if the company does not manufacture, they sell an already complete unit. Okay, hope that's clear. Okay, Sarah, you had a question.
Yes, I have a question.
Yes.
What's the difference between the raw material and the raw material purchases?
Oh, what's the difference? Okay. Now, let me just have a simple, just for to explain this point. Okay, assume that here. How do I try to look for a very small example? Okay, I see that we are in the year 2020, okay, until the month, we are now in the month of August, okay. Now, if we are to make a stock take, okay, we are to go and do an audit of the inventory that you have as a business. How much of raw material can we find, okay, in your store? That's what we mean by raw material. So generally, it's an average figure actually, okay. The raw material is simply an average figure that at any point in time during the year, how much of raw material do you hold as a company? Okay, so if you have to go today, we do a stock take. How much of raw material can we find? Okay, we can assume that therefore to be the amount you hold at any point in time during the year. Okay, is the raw material investment. On the converse, the raw material purchases is the total purchases you have made, the amount of raw material you have bought. From the one you paid, the one you already converted, simply is the purchases, okay? From the month of January until now the month of August, how much of raw material have you bought from the supplier? We call the raw material purchases.
Okay, thank you.
It's clear?
Yes.
Okay, fair enough. Okay, so the three combined give us therefore the total inventory days. But only if the company is involved in manufacturing, because if you don't manufacture, then you have no material. You don't produce, so there's no work in progress. Okay, so you only have be having therefore the final bit. Okay, we'll call the finished goods day. Then we add to this. Sarah, you have another question?
No.
Okay. You can lower your hand up so that okay. Then you have the days for material for receivable. The days for receivable. We'll call the collection period, okay? So days, 365, we multiply by the amounts that we have at any point in time during the year, okay? if you have to take our books, okay, how much do, on average, this customer owes us, okay, or in short, how much of our goods are out there with the customer, okay, we'll call the investment towards the receivable investment. We divide by the cost of, we divide by the sale we made to a customer on credit, okay. Don't forget, a receivable is going to arise in case you do sell on credit. A receivable is a sale made on credit that is still outstanding, okay. So where we divide by credit sales. Within a year, what is the total credit sales? Okay, we less payables days, or referred to as the debtors day, or referred to as debtors day. That is 5. We multiply. Who can give me a formula based on this formula here above here? What are the payables days? It's 5.
Payables
Payables, yes.
over debit days.
Debit day. What do you mean by debit days?
The days the days that you're supposed to be, you have been given to pay.
Okay, I agree. Then how do you get the days you're meant to pay to your suppliers? That's the question. The numerator is very okay. What about the denominator?
The denominator.
Payables divided by? When does a payable arise?
Payable arrives when you have paid the money.
If you're paying money, then that's not a payable. It means you don't need to pay, isn't it? Because you've already paid, isn't it?
Yes.
Now, when does a payable arise? When can you say that, oh, I owe you money? When does that arise?
When I collect goods on credit.
When you collect goods on credit. From you, yes. When you pick goods from me on credit, isn't it?
Yes.
So based on that, what therefore is our denominator here?
I'm not there. I've forgotten.
You've forgotten, okay.
Credit purchases.
Credit purchases.
Credit purchases.
Thank you. It is credit purchases, okay? We divide by credit purchases because the payable is going to arise in case you buy goods on credit. If you can buy goods on cash, then you don't owe me. You already paid what you owe me, okay? Therefore, it's divided by credit purchases. Credit purchases. Someone had a question. I'm not sure who it was. Did someone with a question? Unmute yourself. Did someone with a question? I can't get my control, so I don't know who it is. If you have a question, unmute yourself. Yes, 2 people here. Sarah, you still have a question? Sarah, you still have a question? Daniel?
Yeah, I have a question.
Yes, I'd ask.
On work in progress days.
On work in progress days?
Yeah. Yeah.
Okay.
So the cost of production, is it the total cost of production or the cost of production for that work in progress?
Generally,
is it the total cost of production?
What you have to make an assessment is that at the point when you're trying to make an evaluation of what is the work in progress days, you have to evaluate to what extent is this work in progress. I don't know what the best word to use. To what extent is this complete? I think that's a better term to use. If it is going to become 100% complete on the material, then all material becomes part of production. If it is 50% complete towards labor, then you cannot allocate all the cost towards labor. You allocate only half. That's the point you want to ask. So you have to evaluate, Daniel. Okay, you have to evaluate. Okay, to what extent is this work in progress complete? Okay, Is it 100% complete towards material, 30% towards labor? So because you have to allocate the cost based on the stage of completion. I don't know if that's clear.
Yeah.
Okay, fair enough. Okay, fair enough. Now, in most cases, okay, let me just make a comment here on the payables days. Okay, in most cases, you won't be given, okay, you may not be given, okay, this value, the credit purchases. You may not be given credit purchases, okay, because you're going to be given what we call a summarized profit and loss account. The income statement is going to be summarized, so you won't be able to get a figure for credit purchases, okay. So what therefore do we use therefore instead? With the financial statement to be given to you, quite unlikely are you going to be finding a line item there written total credit purchases for the year. You won't find most of the time. So you have to use something else. So what do you use instead, therefore?
Payables for the year.
Payables for the year. What do you mean payables for the year? But this payables becomes there for the numerator. For the denominator, what do you use? Let me help you out, okay? We use the cost of sales, okay? We use the cost of sales, okay? We use the cost of sales, okay? Because quite unlikely are you going to get financial statement that do give you the total credit purchases, okay? Therefore, in that case, therefore, we use the cost of sales. And actually, this is what you normally use most often than not, okay? Unless the exam gives you the credit purchases, which is very unlikely to happen. So you use the cost of sales. And that's how we do get therefore the cash convert. Those are the formula used when it comes to getting the cash conversion cycle. Okay, I hope they are all clear. So these formulas you have to know them. Okay.
Excuse, sir.
Yes.
Excuse. But you notice that the cost of sales includes even cash purchases.
Yes, it includes even cash purchase. Yeah, it does include. That's kind of the one of the problem. Okay, when it comes to getting the payables days using the cost of sale. Yes, I agree. It includes the employees. You know, payable days supposed to include the employees' days. Okay, it includes suppliers for water, suppliers for electricity, suppliers for the actual goods of the company. You can see it's going to be combined so many things. Okay, so actually, even anything is just an estimate. Okay, so it's not going to be an exact figure for sure. I agree. Immaculate.
Okay.
Yes. Okay. Immaculate.
The sales.
Yes.
Is it the same value as the one for the finished goods?
Sorry, there.
The cost of sales.
Yes.
Is it the same value
Yes, the same.
as the?
Yes. It's the same. So these two are the same. These one and these one, they're equal. Yes, they are. Yes.
Thank you.
Okay. Any other question? Okay. Someone else. Joseph?
I missed something here, teacher. Does it mean that we only use cost of sales when we don't have credit purchase?
Yes, actually, if we have the two figures, credit purchases, and you have cost of sale, we first use credit purchases. You only use the cost of sale in case for sure you can't get credit purchases. That's was your question. Joseph?
Yes, that's the question.
Yeah. Okay. So in case the examiner gives you the total purchase or made on credit for the year, then use that. Okay. But in case they're not given, okay, then of course therefore you can now use the cost of sale. Yes. Okay.
Okay, thanks.
Okay, welcome. Now let's do a question to apply these formulas, because as I mentioned, it's about applying the formulas. Okay, it's about applying the formulas. So let me get a question. Let me get a question here. Yes, so I have this question here. It's clear from your end?
Yes.
Okay, fair enough. Okay, let's do this question. Take a minute, try to attempt the question. Let's see how far you can go. Okay, it seems that some of you have an answer. What do you get? Who is this who have an answer here? So someone. Michael, what's your answer?
190 days.
190 days.
Yeah.
Okay, Sharon, what's your answer? Okay, Sharon.
Yeah.
What's your answer?
I got 192.
192.
No, 190.
Oh, 190. Okay, 190 days. Okay. Let's attempt to see what you meant to have done for a particular example. Okay. I need to escape here. Sorry. Where was I? It is. Okay, definitely we do need to get, you can see for this company, it is a company that is involved in manufacturing because as you can see, the inventory for this company, we have raw material, work in progress, and the finished goods, okay? That implies therefore, this company will for sure be involved in, it is a manufacturing setup. So therefore, that implies therefore, we do need to get the days for raw material, we do need to get the days for work in progress, and the days for finished goods, okay? So we do need to get those days. Okay. At the same time, we need to get the receivable days. Okay. We also do need to get the days for payable. Okay. For us to get the working capital cycle. Okay. Okay. So let me share. Okay, I can just use this formulas here. Okay, so let me just use this formulas here. Oh, we want to get the days for material, which will be equal to the 65. We multiply by the raw material. If we also go back.
$108,000.
Okay, yes, yeah. So it's 109,000. Okay, so of course, let me just get these figures so that I avoid going back and forth. You all have these figures at least. So let me just get these figures to avoid back and forth. Yes, I have them. Okay, so let me go back to my board. It's here. So therefore, it's going to go to, there is 5,000. We multiply by the raw material, which is equal to 108,000. Okay, we divide by the raw material purchases. Okay, in this, we are to purchase raw material for the year was 518. 518.
400.
400. 400. To give us how many days? And by the way, okay, because you can see the days is going to be a decimal. You can either decide to ignore the decimal, all of them. You can either decide to round off the nearest whole number. Okay, whatever you prefer. Just be consistent from the beginning until the end. If you want to use decimal, you can use, but I don't prefer to use a decimal. But just be consistent in whatever you choose to do. If you want to round off to the nearest, do that. Follow them. If you want to ignore the decimal, you don't follow them. But just be consistent. Anyway, how many days do you get?
76.
Oh, you're breaking up. 23.
76.
26 days. 26 days. Thank you. 26 days. Next, we get the days for work in progress. The days for work in progress will be equal to the days 65. We multiply by work in progress, and work in progress is equal to 75, 600. We divide by the cost of production. The cost of production we told is equal to 675,000. Give us how many days?
41 days.
Give us 41 days. Thank you. Next, we have the finished good days. Okay, finished good days equal to this 5. We multiply by the finished good investment. This is 86,400. We divide by the cost of sale, the cost of goods sold. Okay, and the cost of goods sold is equal to 756,000. 756,000. To give us how much? To be the days for finished goods.
42
days.
That's for 2 days. Next, we get the day for receivable. That is the time difference for time that supplier, the customer buy from you on credit to the time they pay you. Okay, it is 5. We multiply by the receivable, and the receivable in this case 172,800. We divide by the cost, the sales that are on credit. In this example, you've been told that these are just sales, not whether cash or credit. Therefore, we make an assumption that all these sales were made on credit. Okay, we make an assumption. Okay, unless we told that they're not on credit, that we assume all sales were on credit, equal to 864,000. Give us how much?
73 days.
23 days. Okay, then we get the days for payable. Okay, the days for payable will be equal to the days 65. We multiply by payable, and the payable is equal to 86,400. Like in this example, don't forget you don't have the credit purchases, so therefore we use cost of sale. Okay, we don't have credit purchases, therefore we use the cost of sale, which is equal to 756,000. To give us
42 days.
Well, therefore minus 42 days. Okay, minus 42 days. Therefore, 41 plus 42 plus 43 minus 76 plus 41 plus 42 plus 43 minus 42 days, and you get how much?
190.
You get 190. So you get 190 days with the cash conversions cycle for this company. 190 days. Okay. That's it. Okay, and of course, in most cases, the examiner is going to ask you for you to prepare or to show the operating cycle or the cash conversion cycle. Okay, so be prepared that you may be asked to apply one of these formulas here. Okay, and by the way, just make a comment. Okay, since I already introduced them here, the reciprocal. Okay, the reciprocal of these. Okay, is the raw material turnover. Okay, just introduce what we call a turnover ratio. Turnover ratio shows how many times has that account investment been converted into a sale. Okay, so here first, this is the reciprocal. So they're in reciprocal terms here. So they are reciprocal of the turnover ratio. So this is the reciprocal of this give us the raw material turnover ratio. This give us the reciprocal will give us the work in progress turnover ratio. The reciprocal will give us the finished goods turnover ratio. Okay. The reciprocal of this will give us the receivables turnover ratio. And the reciprocal of this will give us therefore the payables turnover. Okay. For example, okay, the case of payable, okay, therefore you say payables turnover is equal to the reciprocal is sale is the cost of sale. We divide by payable. Okay, because I don't think I will discuss this ratio. So because I think you already done them. But anyway, somebody the examiner can ask you, get the payables turnover. Okay, or comment on the payables turnover. Okay, don't forget simply the reciprocal of these ratios here. Clear? Okay. Having done that, let's check the examiner. Okay, on the question that your examiner may have asked. I hope you have downloaded the questions from online. I hope you've done that already. Those just in case because you of course you need a question bank. I have a question bank, but now we're out of the university, so there's nothing else I can go to do. So ensure that you download that question bank. Okay, download the question bank. The questions are from CASNEP website. Okay, so they're already there. Okay, so that's what I'll be using for our own revision. So let's check whether. So give me a minute. I try to check whether I can get those questions.
Excuse me, sir.
Yes,
Before
yes.
you go, could you enroll me to the e-learning portal, please?
So the e-learning now, okay, yes. You write an email to the course administrator, you know, Wilta. You don't know, okay, fair enough. Maybe at the end of the class, or actually someone can share her email address so that you can write an email, she can include you to the e-learning. Well, actually, let me just try.
I will guide him. I will guide him on the procedure.
Okay, okay, thank you, Joseph. Okay, so Joseph is going to guide you on the procedure.
Okay, thanks.
Thank you, Joseph. Okay, so give you a minute. I look for the question from your examiner. And of course, in case you get a question from examiner from those past papers the examiner has uploaded on the website, you let me know. As I'm also trying to look for a question your examiner has tested. Okay, I think I've seen one which we can use for the time being. So let me share it. It's it's May 2018, May 2018 question 5 part C. Of course, my question bank, you can't be able to see it. I don't know whether you can see it very well, but either if you can't see it, don't forget, ensure that you download, okay, from the CASNEP. So all this paper I got from CASNEP. So May 2018, question 5C, okay, is a question that I think we can do together, okay, of course, applying some of the concepts that you've learned right now, okay. As I look for a question that is asking us to get a cash operating cycle. May 2018, question 5C. Okay, so I presuppose that you've gone through the question. And now we can get these, what is required here? The cost of sale, gross profit, total sales, total purchases, net profit, debtors value, as well as the payables. Okay, the same with the of ratio. So here is a ratio I've seen that we have not discussed so far. One of the ratio is the current ratio, but it's very easy. Current ratio is simply current assets of the company divided by current liability. Okay, that's what the current ratio. Okay, so current assets of the company we divide by the company current liability is what referred to as the current ratio. Okay, and we shall discuss it in the next few slides. Now let's begin with Roman 1. We want to get the cost of sales. You all can see my Excel.
Yes.
Okay.
Yes.
Okay. So cost of sale. What do we need to do here? You've been given the gross profit margin. We'll be given the gross profit margin is equal to 20%. We've been given the stock turnover. You can see that we have been given the stock turnover, or the so-called the inventory turnover ratio, which is we told is equal to 10 times. Okay. Now, if you remember, I gave you the turnover ratios. Okay, I told the reciprocal of the respective accounts. Okay, is the turnover ratio. For example, the case of inventory. Okay, so allow me to use this Excel here. So inventory turnover ratio. Okay, just to remind you what you've just, I think I've just mentioned to you right now. Okay, of course, we say is equal to. Let me pick someone to give me that ratio. Mary.
Yes.
Yes. How do you get inventory turnover ratio? Mary, it's just a reciprocal of the figures I've just the one we just done right now.
Cost of goods.
Cost of goods
sold over the average inventory.
Over the average inventory. Thank you. Yes. So this is May. Guys, allow me to. I want to have a bank for solution for these past paper questions. That's why you can see I want to use this Excel. As we revise, I also have my answers. So this is May 1. This is May 2018. So May 2018. Okay. Question. What's happening here? So May 2018. May 2018, question 5C. Okay. Question 5C. Question 5C. Okay. So you can be the first one by getting the inventory turnover. So inventory turnover ratio. Okay, so it's given us the cost of sale. So it is equal to cost of sales of the company. So it'll be equal to cost of sale of the company. Cost of sales, we divide by the inventory, the average inventory. Okay. To be equal to the cost of sale of this company, you've been given cost of sale. We have the gross profit, we have cost sales. Average debtors day is 2 months, and the receivable, they have the receivable here. Don't have it. You can get the inventory 10 times. I guess we can get the cost of sales. Because we have the inventory turnover, we can get the average inventory. Yes, I think yes. Okay. Yeah, so let me get here average inventory. Okay. So average inventory. Average inventory, of course, is going with the beginning balance. Okay, so opening balance plus so average inventory, of course, will be equal to the opening balance. Okay, opening balance plus the closing balance. Okay, plus closing balance, we divide by 2. Okay, so we normally do the average. Okay, closing balance for inventory, we divide by 2. Okay, so we can divide here by 2. Okay, so that is going to give, therefore, what is going to be the inventory, which is going to be equal to, so this balance. Okay, so therefore it's going to be equal to the opening balance for inventory. So it's going to be equals to opening stock, we are saying is equal to 450,000. Okay, 450,000 plus closing stock, which is 510,000. Okay, so that's, we divide by 2. Okay, divide by 2. Okay, that's going to give us, therefore, what ought to be, therefore, the average inventory. Okay. Okay, so just do calculation here. This is for, so for 50,000, 23 plus 510,000, 23, because we divide by 2. Okay, and we get for 80. Yes, thank you. We get for 8,000. So that's here, therefore, the average inventory. Okay, the average inventory figure. Then since now we have the average inventory, so that we have the figure there. Let me just expand. Sorry, that's too much. Okay, so now we have the average, okay, inventory. We have the turnover. So now we can get the cost of sale. Okay, where the cost of sale, therefore, you can say cost of sales. Cost of sales, we make the cost of sale the subject of the equation. Okay, we make the cost of sale the subject of the equation. Will be equal to, okay, cost of sale will be equal to turnover times the inventory. So it'll be the inventory here times the turnover. Okay, so they've gained the turnover times the inventory turnover times the inventory balance. Okay, times the inventory. Okay, which will be equal to the turnover from the question was 10 times. Okay, so it'll be 10 times by average stock you have here, which is for 80,000. The average you've just obtained here. Okay, which you have here, the one you've just obtained right now here. Okay, therefore that is going to give, therefore, what ought to be the total calculable sale. Okay, which of course, therefore, is going to be equal to 4.8 million. Clear? So now you have the cost of sale, and actually that was the examiner was just doing the Roman one. Okay, you have the cost of sale equal to 4.8 million. Is that clear?
It's clear.
Okay, fair enough. Okay, but therefore give therefore the cost of sale. Next, you've been asked to get the gross profit. Okay, so next is to get the gross profit. So gross profit for this company, we've been told that if you look at the information just at where you've been given those extracts of financial information, you've been told the gross profit margin is 20%. The gross profit margin is 20%, which implies, therefore, what's the percentage of the cost of sale? If the gross profit is 20%, what is therefore the proportion of the cost of sale? Guys, if the cost
80%.
80%, yes, it is 80%. The difference, it is 80%. That's therefore the cost of sale. Okay, therefore don't forget the cost of sale, therefore, is 8%. Okay, so remember the cost of sale. Okay, cost of sales is equal to 80%. That is 100% minus the gross profit. The gross profit here you have, okay, which is equal to 80%. Okay, which is equal to 100. Okay, so it's 100 minus 20. Okay, so it will give us therefore 80%. Okay, to give us 80%. Clear? Now, how we know that the cost of sale is 80%, and we know the figure for cost of sale, we have it here. There's a figure for the cost of sale, which is equal to 80%. Okay, then from there, we can get the sales, therefore. We can therefore get the total sales figure. Okay, therefore, the sales is equal to, we know that 4.8 million, we know that the 4.8 million, okay, the 4.8 million here, sorry, this is not 4.8, we had another zero. The 4.8 million is equal to 80%, okay, is it clear? The cost of sale, okay, I think the best could be just indicate that 80% is equal to, okay, is equal to 4.8 million. I think that's much better. Is equal to 4.8 million. Well, therefore, 100%, therefore 100 sales here, you can say is 100%. It's 100% will be equal to the 4.8 million divided by 0.8. We divide by 0.8. Oh, that's clear. Let me just get my pen so that, okay, just to illustrate. We know that 80%, let me choose a different pen here, just for our analysis. We know that 80% is equal to 4.8 million. Then the question is that, what about 100%? That's the question. Oh, sorry. What about 100%? Therefore, 100% is equal to how much? Therefore, it's equal to 4.8 million divided by 0.8 million. This is what I've done here. This is what I'm trying to do here. Clear?
Yeah.
Okay, fair enough. Therefore, there's gain given us. Okay, let me just.
6 million.
6.4?
6 million.
6 million.
Yes.
Yes.
Okay, 6 million to be the gross profit, to be the cost of the sales. That's Roman 3. The answer to Roman 3. Because Roman 3 will be asked to get total sales, and we get therefore 6.4 million. Hope it's clear to all of you. Again, for this example, is about working backward. Is more or less trying to work backwards. Okay, I think if you have seen so far what you've done, is attempt to work backwards. Okay. Now, in case we have the sales, now we can get the gross profit. If we have the sales, we can get the gross profit, therefore. But the gross profit is now 20% of the sales, isn't it?
Yes.
Yes, because it told that gross profit margin is 20%. Okay. Therefore, it's game equal to, okay, 20% times the sales, 6 million. Okay. Okay, which is equal to 1.2 million, isn't it? Times 6 million to give us therefore 1.2 million. Okay, therefore that's give therefore the gross profit. Clear? Okay.
Yes.
If you have a question, don't forget you ask. So you're done cost of sales, gross profit, total sales. Now let's do total purchase. Sorry? Yes, yes.
Okay, the gross profit, the 20% is the margin.
Yes, the gross profit margin, yes.
Okay, and then here we've been asked for the gross profit itself.
Yes.
Does it have?
Does it have to?
Okay, I get it now.
Okay.
I thought like I'm supposed to add the figure, the 1.2 to the sales, but if I do cost of sales plus the
I see. No, that's a markup. That's a markup. Yeah, that's a markup. For the margin, you do it. It is. If it was a markup, then you have to do what you're trying to suggest. That the sales will be, for example, 120%. That's higher than it will be 20%. Yeah.
Okay.
Yeah, if it was a markup, but generally, by the way, your examiner is not going to bring markups here. By the way, okay, unless I've never seen it in your exam. So most of the time, it will be a margin. Okay.
Okay.
Okay. That Sharon, that was from Sharon, of course.
Yes.
Okay. So we're done with that. So total purchases. If you check on the additional information number all purchases were made on credit. So since now we have been told that way, that implies therefore, when it comes to get the payables days, you're going to be using not the cost of sale, but the purchases, isn't it? You see it from point number 5, okay? That's what we'll be using, okay? But is it going to help us get anything there? We want to get the purchases, payables days, okay? Have we told the payables days? Yes. In note number 1, credit period allowed by suppliers is 1 month. So it is 1 month. The number of days supplier gives you, okay, it's 1 month. I think from there, and what is it? We have 1 month. We can get the payables. Therefore, from that ratio, we can get the payables. Yes, I think we can get the payables. So we say that the days for payable. Okay, just to remind the formulas that we did. Okay, payables days. Okay, we say it's given us. Okay, we do have the payables days. Okay, I think we can do the reciprocal. Okay, let me just do here. We say that. Let me just get my pen. That payables days is equal to 365, but since now these are months, we just use the month as they are, okay? So use 12 months, isn't it? So use 12 months, so don't convert them into days, because as per Roman 1, you've been given the days in month, okay? Therefore, it will be 12 months. We multiply by payable, we divide by credit purchases. That is the formula, okay? So we have the days, so we have the days, we have the purchases. So what we need to get is the payable. So we just make payable the subject of the formula. Okay, we make payable therefore the subject of the formula. Okay, therefore if you have to make payable the subject of the formula, it will be equal to the days, payables days. It's meant to be payables days. Payables days. We divide by 12 months. We multiply by credit purchases. Okay, that's what you're meant to do, because we want to get a payable investment. Is that clear? I've just made the payable the subject of the formula. Okay, so simply multiply both sides credit purchases by both side credit purchases. That's what we've just done. Clear? Okay. Yes. It's clear. Okay, thank you. So let me just clear off. So this will therefore it will be equal to, okay. So let me just go straight and get the payables investment, because I've just done the made the payable the subject formula. It will be equal to, then yes, it is going to given us just forget the formula again. So payables investment will be equal to the credit purchases, okay, that we do get from supplier. So payables days, so it'll be equal to, let me call this payables days. Payables days, we divide by, okay, so payables days divide by 12 months. So don't convert them by the, okay, the month use month, then weeks use weeks. So don't convert them into days, okay. Okay, so we multiply, okay, so of course here we multiply therefore by credit purchases. So multiply by credit purchases. But do you have the field of credit purchases? That's a question. Do you have the figure for credit purchases? Yes, all purchases were made on credit, but we can't get a figure for credit purchases. Okay, I don't think we need to use that formula because we don't have the figure of credit purchases. So you go back to our formula, cost of sales. Because I don't think, is there someone who can see how we can get the value for purchase made on credit?
Okay, I think what we can do, we'll have, currently we already have the gross profit, we have the sales, and we have the cost of sales. So I think when you use the cost of sales and the opening and the closing, you can get the...
You can get the purchase. You work backward. Okay, I get you. Thank you. We can work backwards. Thank you. Yes, you can get that. Thank you. Yeah, I think we can work backward. Where we say the cost of sale, okay, where you say the cost of sales is equal to, and it's arrived at. So here we have closing stock. So you work backward. Okay, so closing stock was how much? Closing stock we told is 510. So closing stock 510,000. Okay, purchases, which we don't know. This is what we want to get. But here the opening stock. Opening stock, which is equal to, how much is it? 450, to give us 450,000. We know the figure for cost of sale, so I think I can just plug in here the cost of sale figure. From working, we got, where is that? Cost of sale, it's here, 4.8 million. So 4.8 million. Therefore, how much therefore is the purchases? So you're simply working backward. I get you. You get how much? To be the value for purchases. Okay, so I type here. So give me the figure for purchases.
I'm
Yes,
getting
sir.
4.
Sorry?
I'm getting 4.86 million.
4.86 million. Okay.
Yeah, for the part.
For about purchases. Okay, fair enough. I think we can attempt it together. Okay, so we are trying to work backward. So closing stock here was minus 510,000. Purchases is a balancing figure, okay, which will be equal to, okay, if I was to work backward, it will be equal to 4.8 million, okay, plus 510, just to confirm whatever you get, okay, so minus 450. Again, a really different figure. And I think I've made a mistake because purchases, cost sale is a sum.
Okay.
Equal to, just a minute, let me check, 4.8 million, okay,
Supposed to be
510 minus 450, okay, because I'm getting this figure here, I think there's a mistake somewhere I'm making. Where am I making a mistake? It's about working backward. I have the cost sales here. I need to add back 510. Because it's a minus, I get it. Because it's a minus, it's meant to be minus minus, so that it becomes a plus. Thank you. That's the issue with Excel. So it's meant to be a minus. Yes, so we get 48.6. That's what we got. Confirm? You got 48.60.
Yeah, it's 48.60.
We get 48.60 to be the purchases. Yeah, thank you. We get 48.60 to be the purchases. So let me just delete my writings here. So that's you, therefore, the company purchases for the year. And you'll be told that all these purchases were on credit, okay? So they're on credit, okay? So having done that, I guess now you can apply the formula and get the payable. Therefore, the payables will be equal to, payables days was 1 month, so 1 out of 12, okay? We multiply by the credit purchases we have just done here, which is equal to 48.60. And you get how much?
$4.5.
4.5, okay? So I think my Excel is a calculator. I just confirm. So you get 4.5, thank you, okay? And we get 4.5 to be the payable, okay? And that's the answer for Roman, for number 6, number 7. Number 6, that's the answer. We get the creditor's value, okay? So if working backward, we get 4.5 to be the creditor's value, okay? Thank you. So what do we have? Debtor's value. I think we can get debtor's value. Okay, so if the same formulas to get the debtor's value, okay, simply the receivable. The receivable, okay, let me go back to what we make we make the receivables to be the subject of the equation, which we already know. Okay, just recall, we say that the days for receivable, the receivables days was equal to 365 on month. In this example, in Roman 2, they're in months. So use the month here for 12 months in a year. So 12, we multiply by the receivable. We divide by sales made on credit. Sales, isn't it?
Yes.
Therefore, if you make the receivable, I just want to make the receivable the subject of the formula. Therefore, the receivable will be equal to the days for the debtors divide by 12 months times the sales made on credit. That's simply making the receivable the subject of the formula. Okay?
Yes.
Then I can just work backward. Okay, so in case I work backward here, so here the days as per month given in Roman 2 is equal to 2 months. Therefore, the average debtors day is 2 months. So 2 months, okay? So 2 months, okay, out of 12 months in a year, multiplied by the sales made on credit. Now here, we've been told that in note 6, the sales on cash were quarter. Therefore, the quarter were on credit. Okay, isn't it? So 3/4 of the sales were on credit because a quarter was on cash. Therefore, the balance was on credit. So multiply by the total sales, which we got somewhere. Total sales, we have that figure already somewhere. Sales, the company, which is this year 6 million. Okay, because we've done 6 million. Okay, therefore we multiply by 6 million. Okay, so times 6 million, 7 by 6 million. Okay, that therefore give us therefore the credit sales of the company. Okay, so to give us 4.5 million. To give us 4.5 million. Thank you. To give us 4.5 million. Okay, so having done that, we simply multiply by the sales on credit. Okay, which is equal to the 4.5 million we have just obtained. 4.5 million. Clear? And you get, how many days do you get?
750,000.
So we get 750,000 to be the account receivable. We get 750,000 to be the account receivable. Okay. So we've done that for Roman 6. Then we're being asked to get the net profit. Okay, the net profit of the company. Now the net profit of the company, of course, is the gross profit minus what is going to minus. Okay, it's already given to us. The net profit margin, is it given to us? Yes, it's there already. Wow. Okay. Really given to us. Yes, Immaculate.
I didn't understand on credit sales.
On the credit sales. Now, in case you check on note 6, can you see note 6? Can you see note 6?
No.
Wow, you can't see note 6 on the question bar, on the question from the examiner. Note 6. Additional information number 6. You can see it.
Yeah.
Okay, so a quarter were on credit, were on cash. Therefore, the credit must be the quarter, isn't it? The balance.
Okay. Yeah.
So the quarter times size multiplied by total sales. And the total sales we got 6 million from our previous working. We got 6 million. You know this. Here, it's here. We get 6 million from our previous working, isn't it?
Yeah.
Yeah. Okay. Yeah. So that's how you got the receivable.
Oh, thank you.
Okay. So next we have net profit. Okay. So the net profit margin. Okay. So for the net profit margin, of course, we be told is equal to 15% of sales. Okay, 15% times sales. Okay. 50% of sales. Okay. You have to give us therefore 15%. Okay, just put the sales figure here of 6 million. Okay, because sales is 6 million. Okay, therefore there's gain divided therefore what ought to be the net profit. You get how much? Confirm whether they get 900,000 to be the net profit. Sorry, okay, this is not a margin. This is simply the net profit.
9,000. 900.
Okay, so we get 900,000 therefore to be the net profit. Okay, So simply working backward to get these figures. Okay. And actually, some of these questions, these are 12. They are 12 free marks for sure. 12 or even 14. There's a lot of marks. These are 14 marks. Wow. That's a lot of marks. They're 14 or 6, I don't know. These are really out of marks, which you can get. You can see within some few minutes you're already done. Okay. But of course, you have to know these ratios already. You have to know these ratios. Okay. Question? Okay, so in case there's no question, then I guess.
Can we do another example?
Another example. Okay. Okay.
Oh, yeah.
Sorry. So what do you think?
We are saturated.
You're full to the brim.
Yes.
Yes.
Wow. Okay. Okay. Hold on for that example. Then we shall do it next class we meet. Then, isn't it?
Okay.
Yes, please.
Yes.
Okay. Fair enough. So the next time we meet, then we shall do more examples for sure. Okay. Okay, fair enough. Then we can meet next on Wednesday. Okay, so use the same link to access our class. So see you then on Wednesday. And now I'll start giving you assignments. I'll tell you how we shall be doing the assignments now, because you need to do the practice. In finance, by the way, not even finance, in any professional paper, if you don't do practice, then some of these concepts won't stick. Okay, so we shall see how we shall be doing the assignment. Okay, see you on Wednesday and enjoy your evening then.
You too. Have a nice time.
You too.
Thank you. Don't forget to sign the register.